Welcome back, everyone. Today on the Joseph Carlson Show, the market is selling off. A lot of companies that we love, a lot of these great stocks like S&P Global are selling down big today and yesterday. S&P Global is down 3.9%. Netflix is getting liquidated. This stock is going through a massive sell-off, down 5% today, down around 10% yesterday. It's now down to below $900 per share. It was just above $1,000. Spotify is likewise being liquidated. It's just being sold off like crazy. We have companies like Palantir. This one's even in the red just a little today, but it's down $80 over the past month. It's gone down from over $100 to $80. So we see a sell-off in Palantir. We even have companies like Costco, the king of the stock market, the one that is impenetrable. It never sells off. It's down 6.97% today after earnings. That's unusual. Usually Costco does not sell down after earnings. And this continues on and on. There are some companies that have held up better than others, but overall, there are many high quality companies, great ones. Some of the best companies in the world selling off. They sold off a lot over the past couple of days. And since we're finally getting some weakness in the market, some fear and some selling off over the past couple of days, I thought it might be a good time to take a look at the valuations of these companies, to pull out the old calculator and do some math and try to determine which ones are good buys and which ones still aren't great buys. And that's what we're going to be doing in this video. I also thought it would be more fun to put this into a tier ranking where we have 4 different categories. So we're going to categorize all of these stocks off to the left here in one of these 4 categories. So we're going to be valuing all of these stocks, and I'll be highlighting the ones that I think are great buys today, the ones that I think are undervalued. And as part of this, I've developed a new tool to help out in the valuation process. That is the Qualtrim Discounted Cash Flow Calculator. This is something that I just released yesterday. You basically just put in a stock, you can throw in any one of them, and then you can start building assumptions based on the earnings or the cash flows. Now, this is super simple. You just take a couple assumptions like the earnings per share growth rate, the appropriate multiple that the stock should trade at, and then it builds a chart of your expected return. For example, if I thought that Netflix was going to grow at an earnings per share rate of 25% over the next 5 years, and then I think the appropriate earnings multiple is around a 27, then we can see that the return looks like this. Netflix will have a return from today's price, the current price right now, of 14% CAGR over the next 5 years. But then you can change around these assumptions. I can say, what if it only grows at 20%? I only get a 9.6% return. What if it trades down to a 19 forward PE ratio? Then I only get a 2% return. And we also have the desired return. This is your discount rate or your hurdle rate. For example, if I want a desired return of 15% per year, then in order to get that, I would need to pay $476 based on a 20% earnings per share growth rate and a 19 PE. Now, if it grew at 25% and it had a 27 PE, to get the 15% return, I only need to pay $830. So this discounted cash flow tool allows us to put in some basic assumptions and get immediate feedback on how much we'd have to pay. And we can do that for the earnings per share or the free cash flow per share. It works in both cases. I can use the free cash flow per share metric and put in the same assumptions of growth rate, free cash flow yield, my desired return, and it also projects out the return. Valuation, after all, is the combination of both the story of the company, the qualities of it, the intangible characteristics like the leadership, the market position, the competitive dynamics, all of that type of stuff that you do with your studying and looking at a company in combination with the raw numbers, how much you're paying and how much you'll get out of the company. So when we look at this and we look at Qualtrim Insights and we learn about a company, we get data to inform our assumptions. Looking at all of my knowledge and assumptions for these companies, plugging them into the calculator, and seeing what my expected return is. So this is going to be a massive video, and hopefully it will give you some thoughts, some insights, at least some second opinions on valuations about these companies. Now let's go ahead and jump in, and we'll start off with Apple. I've gone through the valuation a couple times with Apple, and every time I come to the conclusion that this stock is overvalued. That's what it comes to every time. When we plug in Apple, we have to decide whether or not we value it based on the earnings per share or the cash flow. I'll just choose the earnings per share, but I come to the same conclusion even if I choose cash flow. So either way, we can choose what we want to value it, but when I choose earnings per share, it presents me with some data. The trailing 12 months EPS for Apple is $6.31, so that is the starting point of this valuation. We're doing this over a 5-year projection. So how much will earnings per share grow on average every single year for the next 5 years. This is the tough part. It's up to our judgment, so you can try out a few different numbers here. For example, I don't think that Apple's going to grow their earnings all that fast. At least I don't see anything in the pipeline that makes me believe they're going to have astronomical growth. Do you see anything? I don't see any new devices or anything. Maybe the AI upgrade cycle. But if we look at Apple and we try to look at the history, this has been a tough position for Apple. They haven't grown earnings per share at all for the past couple of years. In the past 2 years, they've grown at 3.42%. So it's gone through a little bit of a slow period. Now, I think it will speed up a little bit, but not a lot. I might put in like 7% here. So let's see what 7% growth looks like over the next 5 years. Then we get to the next tough part for Apple. The trailing PE ratio is a 37. Even on a forward PE, if we look at that, it trades at a 29. The forward PE is at a 32. So Apple's trading with slower growth expectations and a higher multiple. Even if I put in that I think the appropriate multiple is 30, I get 2% returns over the next 5 years. Just doesn't look great. To make this stock work, I have to assume around 12% growth and a 35 PE ratio. That gets me a 10% return. So even with these lofty assumptions of 12% earnings per share growth over the next 5 years, a 35 multiple, I'm only getting 10% returns. To get the 15% returns, which is the desired return I have for my entire portfolio, I want my portfolio to double every 5 years. That requires a 15% intrinsic growth rate. I'd need to pay $193 based on these lofty assumptions. So I need to pay less than it trades right now today, and I need to have great assumptions to get a 15% return. This is the reason that I've been selling Apple. Any way that I look at it, it doesn't really matter. It's the combination of the current multiple and the implied growth rate. Apple would need to dramatically speed up their growth rate to 15, 20% earnings per share growth per year to make this stock look attractive here. And that is why I'm putting Apple in the selling category. I've already gone through the decision to sell this stock, and I've already reduced my position around 90%. So it's now a 0.5% portfolio holding. Now, next up, we have another big tech holding, which is Google. Let's go ahead and run some scenarios on this one. And I've gone through and ran a bunch of assumptions on Google, and I'll show you what I've currently found. Now, right now, Google has a trailing 12 months earnings per share of $8.13. So that's the starting point for this. When we look at Google's earnings per share growth, it's actually quite fast. Unlike Apple that's been stagnant for the past couple of years, Google has grown theirs 33% over the past 2 years. If you recall, every time I cover Google's earnings, I'm blown away by how good they are. They beat their expectations, they grow their earnings per share, everything seems like it's growing really quickly. But the company never gets credit for it. It never does all that well, even though every earning report after earning report, they're doing incredible. So knowing that Google grew their earnings per share 38% last year, 33% over the past 2 years, 26% over the past 5 years, and 22% over the past 10 years. Even on a long-term basis, this company's growing super fast. We can use that to guide some of our assumptions here. We can assume that Google's not going to grow as fast in the future. Let's just say it slows down quite a bit from the 22%, 26% range all the way down to 15%. So let's just assume that Google growth slows down a lot to 15%. We can plug that in here, and then we can also assume that it trades at a low multiple, barely above the S&P 500, but still below every other big tech company, a 21 PE ratio. These are low assumptions. And based on these assumptions, you get a 14.69% return, almost a 15% return. To get the 15% return, you'd have to pay $3 less than today's price. That's based on a 15% earnings per share growth rate and a 21 PE ratio. These are really low expectations, but let's go even lower. Let's say the growth slows all the way down to 10%, and then we have a PE ratio of 19. Even in this case, where you're getting 10% earnings per share growth, a 19 forward PE, you're still getting a 7.5% return. That's not bad. That could be market matching. So the reason that I think Google is an attractive company today is because even with anemic growth expectations and low multiples, you still get an attractive return. On the flip side, if Google does grow faster than expected, around 18% per year, and that causes the multiple to go up, Let's say investors get more bullish and they trade it closer to Apple or Microsoft or Amazon, up to a 25 PE ratio, even closer to Meta. You get a 21% return over the next 5 years. This is a 22%. That would mean that Google would trade for a price of $464 in Q1 of 2030. Based on the relationship of the quality of the companies mixed with the risk reward of the current pricing, I view Google as undervalued, and I think it's currently a great buy. Now, next up, we have Costco. Where does this one belong? Well, Costco is a company that I've held for a long period of time. In fact, it was one of the first buys I did in the passive income portfolio way back in 2017. And I've slowly added to this position over years. Now, I actually have not bought the company for the past couple of years. I've just held my shares. And over that time period, it's been one of the biggest winners in the market. Investors love Costco. Customers love Costco. Employees love Costco. Cities and governments love Costco. It's one of the most beloved companies by everybody in the world, and it continues to have incredible success. Today, it's down big, 7% in the red today after earnings, and that can give you the impression that these were poor earnings. Spoiler alert, they weren't. If I want to mention a couple things about the earnings, revenue beat expectations, which Costco is a revenue company. You can hear it from the management. They drive revenue growth. That's what they do. The earnings come second. They're not worried about margins. They don't care about making earnings in the short term. They care about growing revenue, expanding across the globe, and growing and growing and growing. Look at the membership growth. These are not free members. These are paid members. And it grew 1 million last quarter. 1 million before that, 1 million before that, couple million before that, million before that, and so on and so forth throughout its entire history. Every quarter, it continues to add on 1 million or so new members. That's what this company does, is it grows in land, it expands, it grows more territory, it steals revenue and market share from other companies. It's almost impossible to even conceive of a better company. So when I look at Costco, I think in terms of quality, it is of the highest tier, the most predictable, fast growing, and most well-liked, with the lowest amount of disruption risk in the future. Now, having said that, when we make some assumptions here, we can bring up Costco. And again, we'll use earnings this time. I think it's very relatable. A lot of people look at the earnings per share to value Costco. So let's just go with that. The trailing earnings per share over the past 12 months was $17. Now, if we assume an earnings per share growth rate, we can plug in maybe 14% here. It's been 15% for the past 5 years. So let's just assume we have a continually expanding, growing Costco. This is where things get tricky. If we plug in an earnings multiple of 30, we're flat. This is a company not making any gains for 5 years with 14% earnings per share growth and a 30 forward PE. That's because of how high the stock already trades. Now, if we bump it up to a 35 forward PE ratio, I think this is probably more reasonable. We only get 4% returns. If we keep going, and you can look at the chart adjust here, we go up to a 40 PE ratio. We get 6.7% returns per year. If we go up to a 45 earnings multiple, then we only have a 9% return. If we go all the way up to a 50 PE ratio, we have an 11% return. So Costco's returns are highly dependent on having fast earnings growth and maintaining a high multiple. If it doesn't do either of those things, you have poor returns. For example, if the earnings per share growth goes down to 10% and the multiple goes down to, let's take a look here, if it goes down to 34, that's where we have negative returns. So as much as I love Costco and the qualities of the company, I put this one currently at overvalued. I'm not selling it. I haven't taken that step yet. I will get there if it gets to a point where I think it's just incredibly overvalued, the point where I don't see any path for positive returns. The reason that I'm not selling this one is I'm naturally very reluctant to selling what I consider to be quality companies, even for valuation concerns. Now let's take a look at a stock that I don't currently own. This one is FICO. I've had this one on my radar for a while. Let's take a look at the valuation. Over the trailing 12 months, they produced $27.89 of free cash flow per share. Now, if we look at this on a historical trend, we can look at the free cash flow here. If we want to look at it on a per share basis, we can select this and we see the growth of it over time. It looks very fast. In fact, last year it grew 39%. Before that, over the last 5 years, it grew 26%. And then over the past 10 years, it grew 21%. So FICO is one of these companies that's so monopolistic. It is so ubiquitous with ratings and loan origination and getting different credit ratings. that they have immense pricing power, and they've relied heavily on that pricing power and those price increases. On top of that, they've done leveraged buybacks. Leveraged buybacks means that they're taking out debt to buy back shares, rapidly reducing the share count, which makes it so that their free cash flow on a per share basis grows really fast. So you're seeing the beautiful outcome of all of these type of economic tools. That is the 21% intrinsic value growth of the company. So we can make a couple assumptions here. Let's assume it grows at roughly the same speed over the next 5 years, 20% per year. And we have a free cash flow yield that moves from 1.5% more to around 3%, which is closer to the market average. If we do that, we only get a 5% return, 5.44% over the next 5 years. In fact, to get the 15% return we want, we'd have to buy it around $1,100 per share. So when I'm looking at FICO, that's closer to the price I want to pay for it. I want to pay $1,100, $1,200. I don't want to have to pay $1,700. Sure, it could grow faster than expected. Maybe it grows 25%, or maybe the price of it stays at a very low yield, a very high multiple of 1.5%. That could happen, and I get great returns if that does happen, but I think it's unlikely. And as an investor, I want to have some margin of error. I want to have some room for failure. In this case, unlike the scenario with Google, where I have very low assumptions and still an attractive return, if you have very low assumptions, if FICO goes to a 4% free cash flow yield and it grows at 18% per year, we get negative returns. So this is a company that's reliant on extremely good performance for the next 5 years and a very, very low free cash flow yield or a high multiple. If I put FICO in a category, it's between the fair valued and overvalued, but I'm going to put it in the fair value today. I don't think that FICO is dramatically overvalued. I also don't think it's a particularly good buy today. I think it's just fair valued. Next up, we have another stock I own. This is a winner in my portfolio, but one that I continue to own, and it's one of my top positions, which is Amazon. Where does Amazon belong today in terms of valuation? Well, if we look at what's going on with Amazon, investors are saying they don't want to own it. And what are we doing here? What are investors doing? Selling Amazon back down below $200 per share. This stock was up big just a couple months ago. In fact, it went up to $242 per share, and investors are selling out. It's now down 12% year to date. What are investors doing? Are they thinking that Amazon isn't a great company because of tariffs? Amazon, a company that will be around for 100 years, is being sold off because of tariffs that we don't know if they're going to be around next week. That's the mind frame from investors. So let's take a look at Amazon. Now, I've talked about the qualities of the business. If you want some input on that, just watch some previous episodes. But I view Amazon as an incredibly diversified, high-quality company with multiple aspects of its business that are high margin, that are growing relatively fast. So the most profitable portions of the business are growing faster than the lowest margin portions. Now, some investors get concerned because they're spending a lot of money on CapEx, but Amazon has routinely had high returns on CapEx and high returns on capital employed. And I think they will in the future. If we look at the earnings per share growth, you can see it grow over the past 5 years by 37%. So they have super high earnings per share growth, faster than most companies. In the past year, it was 90%. Amazon is a vast, massive business with massive fixed expenses and operating leverage. The AI efficiencies, robotics, and logistics efficiencies mean that this company can produce far more profits and net income than most analysts expect. And that's been the case for a number of years. So when I look at Amazon, I still expect this company to have rather fast earnings per share growth and cash flow growth. Now, I've looked at this one on both cases, and I come to the same conclusion. We can look at some assumptions here. Again, it grew around 90% last quarter over the trailing 12 months. I think it's going to grow maybe around 25%. I think the company should trade around a 28 multiple. That gives me a 20% return compounded over the next 5 years based on today's price. Off of that, we have an Amazon share price of $482. Now, let's go a little bit lower. Let's lower the expectations. Let's say it trades at a 25 and the earnings per share growth is only 20%, which again, I think is very low expectations for Amazon because this company is not like the average S&P 500 company. It's not going to struggle for 10% earnings per share growth. They have AWS, they have advertising, they have Amazon Prime Video, they have memberships, they have operating leverage with their business and their facilities and all of this. If it grows at just 20% and has a 25 multiple, that is a large amount of multiple compression from today's 35 PE ratio, we still get a 13% return, which is likely S&P 500 and QQQ market beating. Now, for these assumptions to work to get the 15% return, we need to pay 174. Based on today's trading, we could get there pretty soon. So when I look at Amazon and I toy around with the assumptions and what's expected in this stock and how low things have to go for it to give me a negative return, I come to the conclusion repeatedly that this stock is undervalued. I think that Amazon is a great buy today. While investors are concerned with political news and they're concerned about different companies, those are often buying opportunities, and Amazon is a company that I believe is indestructible. Next up, we have the largest holding in my portfolio, S&P Global. This is a company that I'll just put right now as undervalued. I've talked about it routinely. You probably know I think it's undervalued. But if we look at S&P Global, it's a stock that if we value it based on the free cash flow per share, and we assume a growth rate of 14%, which they can do. They can accomplish a 14% free cash flow per share growth rate and a yield of 3.2%, which is a completely reasonable yield. We don't just get a 15% return, we get a 17% return. So this one, based on these assumptions, which I believe are very realistic, we get a way above market return. Even when we take these assumptions down, we assume the growth rate goes down to 12%, then we still get a 15% return. If we think the growth rate goes down to 10%, we get a 13% return. So when I look at this and I toy around with the assumptions of multiples and growth, if we look at it at a 4% free cash flow yield, we're still getting a nice, healthy 8% return. Overall, S&P Global is undervalued. That's why it's at the top of the list. Now, next up, we have one of the companies in my portfolio that grew into one of the largest positions. It was like my third largest position, and over half of it is from gains. So it just grew a lot with gains. That's Texas Roadhouse. It's a stock that mostly I talk about. I don't see much other content created on it because it's a relatively small company, a $10 billion market cap, and it's a restaurant company. Now, I went there recently and completely underrated item, the seasoned rice. Try it out. It's got onions in it. It's so flavorful. Some of the best rice I've had. But anyways, if we look at Texas Roadhouse, where does this one belong? Let's take a look. Texas Roadhouse is surprising because when I was doing my analysis on restaurants originally, what I was doing was basically looking at the predictability, the reliability, the volatility and earnings and revenue in all different environments. And what I noticed is that Texas Roadhouse was extremely resilient. It was consistent. You don't see that often with even other restaurants. So this stock had figured something out, and they've done the same with their earnings per share growth. Now, the earnings per share growth is startling how much it's grown recently. Texas Roadhouse has consumed other restaurants, ones that have gone out of business, ones that are struggling. You have a list of companies, I could go through them, that are struggling in the restaurant category, and Texas Roadhouse is taking their patrons. So when we look at this, they've grown their earnings per share by 43% year over year last quarter. Now, 43% over the past year is remarkable. It's faster than most of big tech and high-tech AI growth, all that type of stuff. And you can see this exceptional growth over the past 4 quarters. So that's what we're looking at here, is a company that's having phenomenal growth. But my expectation is that that's going to slow down dramatically. If we get into a consumer-led recession or any type of weakness in the economy, even though Texas Roadhouse, I think, is better value than most restaurants, it is going to be impacted. It is part of the economy. It's going to be impacted when things go down a little bit. So my expectations when I'm looking at this stock is that we're going to see a slowdown, and we might see a re-rating in the multiple, meaning the PE ratio may drop a bit. So I'm going to bake that in to my valuation. Now, again, it's grown at 43% last year. But let's just assume it goes all the way down to a 15% growth rate. Massive deceleration and more in line with the company of its structure. We look at the appropriate multiple, and let's say this goes to a 22 from the 25 to 26 right now. We get an 11% return. That's still good, but these still are very healthy assumptions. Let's say that the earnings per share growth slows down even more. We go to an 11% here, and we have a multiple of 20. Then we get 4.6% returns. So Texas Roadhouse is in the category where I think it's going to provide positive returns. I think it will be a good company, but I don't believe it's any type of particularly exceptional buy today. I have to put this one in what I believe is just the fair value category. Now, next up, we have the company Moody's, which is similar to S&P Global. Let's just take a quick look at this one. When I look at Moody's, it's very similar to S&P Global, but it's not quite as diversified and it trades at a little bit higher of a valuation, which means that the free cash flow yield is a little lower. Now, when I look at this one in terms of valuation, I plug in a 14% free cash flow per share growth rate. I think the appropriate yield for this one, pricing in the qualities of the company, is around a 3.5% free cash flow yield. And based on that, I get a 10.9% return over the next 5 years. Not bad. It'll probably still be market beating. But when I look at the entry point needed for that 15% return, I need $381. Currently, it trades at $456. Right now, Moody's is fair valued. If it sells down a little bit more to the 380 category, it's undervalued. Now, next up, we have Palantir. Do we even want to do this? I mean, do we want to look at it? Let's go ahead and just bring it up here. Palantir, let's take a look. Okay, we have it here. Let's take some simple assumptions. The PE ratio trailing is 399. The earnings per share are 19 cents. Maybe we look at this one with cash flows. Maybe that would be better. The free cash flow yield is 0.61 and the free cash flow per share is 50. It has some stock-based comp impact, but if we have free cash flow per share growth, it takes into account a lot of that dilution. So maybe we use the more favorable view, which I think is the cash flows. We'll take a look at that. Now, Palantir has been growing their cash flows rather fast. If we look over the past year or so, they've grown at 55%. So that's a very fast growth rate, 138% over the past 2 years. So the growth has been fast, but you can see it decelerating, 138 to 55. It's likely going to decelerate a bit more over the next 5 years. So we can plug in some basic assumptions here. Let's say it grows at 30%. And let's say the yield of the stock moves to 2%. That's still very expensive, but not quite as expensive as the 0.6% free cash flow yield. When we plug that in, we get a return of 2.5% over the next 5 years. So it's positive. You still get a positive return from today's price. Now, if you assume that the stock stays really expensive and it trades at a super low free cash flow yield, like 1.5%, you get an 8.6% return. If we keep going a little bit lower, we go 1.3%, 1.2%, the return goes up more and more. If we assume that it's going to trade at a 1% free cash flow yield, which is a 100 to 1 free cash flow multiple, that is a 17% return. And that's all based off a 30% 5-year compounded growth rate of its free cash flow per share. So looking at Palantir, this is a company that does have a path of positive returns over the next 5 years. It needs to grow fast and remain at a high valuation. If you make both of those assumptions, this could turn out to be a money-making stock. But if the stock grows slower and it trades at a lower valuation, you likely have very poor returns going forward. So I'm going to throw this one in the overvalued category right there along with Costco. The expectations are super high. Future expected returns are a little lower over the next 5 years. Next up, we have ASML. And this is one that I bought in new in the portfolio. I bought it during a dip because I believe this one is currently undervalued. I'm going to put it there and I'll explain why. You can see it went as high as $1,080 and now it's currently traded down to around $725. So we're going through a nice sell-off in the stock, but the fundamentals continue to improve. The market structure continues to improve. It's a company that's surrounded by geopolitical concerns, but the fundamentals of the business get stronger and stronger every day. And this is one that I like even more today than when I originally bought into it. So as the stock price drops, I feel more confident in the future of this one. The assumptions I make are pretty simple. I think the stock will grow its free cash flow per share at 20% for the next 5 years. I think it's going to be able to accomplish that. I really do. Then you assume that it's roughly going to have a similar free cash flow yield over the next 5 years. So I'm not assuming that it gets more expensive and investors are paying more for the company. I assume they're going to pay just around the same as the low price today. And that gives you a 17.73% return over the next 5 years. ASML would be worth $1,640 in 5 years from now. That's Q1 of 2030. Now, let's assume that investors pay a little bit more because the growth rate looks a little better, things in the economy improve a little bit, or the geopolitical concerns go down a little bit. In that case, we have 21% returns in 5 years, giving this one a 3% free cash flow yield. That would be a share price of $1,920. So this is a company that, based on, I believe, very fair, well-grounded expectations, is a very attractive stock today. Now, it does have some risks, so maybe it doesn't turn out that way, but I believe currently the upside far outweighs the downside. Next, we have a software company in my portfolio, Salesforce, led by Mark Benioff. Last quarter wasn't great. It was kind of a bummer report. It didn't excite investors. The numbers were okay. The commentary was okay, but there's nothing thrilling about the Salesforce report. So investors have been a little bit less enthused about the stock. It's been selling down. Regardless, I still think the company is undervalued at the current share price. And that's because even though Salesforce is not the most exciting company today, it does trade at a low valuation. Look at the PE ratio of this company, a 25 forward PE, a free cash flow yield of 4.6%, even factoring in their large amount of stock-based comp. It's a 3.5%. When we look at the company, it's trading down every single day. It's sold off 15%, and I think it offers a more attractive entry point today. So when I look at Salesforce and I apply some basic assumptions based on the free cash flow per share growth, I think they can grow 12% per year. I think if they trade, even at a low valuation, of a nice 4% free cash flow yield, the stock gives a 15% return. I'm baking in very moderate expectations and I still get above average performance. So at the end of 5 years, this one should be worth $571 based on these assumptions. Now again, we can mess around with these. We can say that the free cash flow per share growth will grow even slower at a 10% rate. Even with a 4% yield, that's still a 13% return. So it takes a while for us to get below a 10% return. Unless Salesforce really does go downhill and it stops performing completely, most scenarios show that this company is likely undervalued. Next up is Microsoft. Let's go ahead and take a look at the history of this one, just a brief glance at it. Microsoft trades at around a 28 PE ratio, a 31 trailing. We have a stock here that continually grows around the range of 12 to 15% in earnings per share. It does the same roughly for its free cash flow per share. So we have 12% growth over the past year, past 2 years it's 17%, past 5 years it's 17%, the past 10 years 17%. So Microsoft's growth has been a little bit lumpy at times, but overall very fast. And the stock has become more diversified, more dependent on cloud revenues that I believe have better pricing power. So when I look at Microsoft, and I plug in my basic assumptions for this company using the earnings per share growth, this is what they look like. I do an earnings per share growth rate of 13%. Now, some people may reasonably argue that this is too high of an appropriate multiple for this company because it's not growing 20 or 30% per year. But I would push back against that. Companies that are growing above market speed, above 10% into the 13% range, usually get higher multiples. Now, companies that are indestructible, globally diversified, have a slew of products that are meaningful to the entire globe, also get higher PE ratios. So the value that Microsoft trades at, or the multiple it trades at, is a reflection of how high quality this business is, how indestructible it is, how diversified it is, how geographically and product diversified it is. It's a very unique business, and it deserves above a 30 multiple. It really does. So when I look at Microsoft, between these two assumptions, we see the projection here. Based on these assumptions, we're going to have a return of 13.5%. That's good, probably market beating, but it's not the best return. It's not the 15% we're looking at. To get a 15% return as our benchmark, we need to buy the thing at 364, and it trades at 388. What I've decided to do is put this one in the fair valued category. I don't think Microsoft is expensive today. I don't think it's a particularly good buy today. I think it's just a great company. It'll likely outperform, but not to a huge degree. Next up, we have a stock that's taken a little bit of a backseat in my portfolio, and that is VICI. This one I haven't been talking about too much because I've been selling out of it. So I'm not going to spend a whole lot of time on this one. I like VICI. It's a very high quality real estate REIT company, but I've decided for my growth path, for what I want for the next 20 or 30 years, I'm just seeking companies that I believe have higher potential, but I still hold a little currently. Now next we have Mastercard. Let's take a look at where this one fits in. This is one that I feel like I don't talk about too much, but it's also been a little bit of a sleeper stock in my portfolio. I have $104,000 of total value in it, 31,000 of that being gains. So it's been actually a great performer. Mastercard has outperformed the S&P 500 and the QQQ over the past year by a decent margin, but where does Mastercard belong today? Mastercard trades at a 34 forward PE ratio and a 2.9% yield. It looks a little cheaper on the cash flows than it does on the earnings, so you can do valuations both ways, but this is a company that is still incredibly strong in such a good market position. If you haven't seen it, look at the interviews of the CEO. He understands the landscape for processing in all the different territories more than possibly anyone. This stock has grown its free cash flow per share at a consistent rate, very high speed for the past decade. Over the past 10 years, it's grown at 19%. It's incredible. It's grown at 16% for the past 5 years, 21% for the past 2 years, 25% last year. So very fast free cash flow per share growth. Let's value this one based on the free cash flow per share growth. So we're looking at cash flows. It has a trailing free cash flow per share of 15.6. If we assume that the growth rate of the free cash flow per share slows down to a 15% growth rate from a 20%, and we assume it trades at even a lower valuation, so the stock is not getting the same treatment as it is today, let's assume it trades at a 3.4% yield, we still get a positive return. It still looks good at 11%. That's assuming 15% growth and a 3.4% yield. Now, if the growth slows down a little bit more, maybe 13%, we're still getting decent returns, a 9% return. So overall, I think things look good today under most scenarios. To get a real negative return or a poor return, we have to assume that growth is cut in half over the next 5 years, and that the yield of the company becomes cheaper, meaning investors don't want to own it. I don't think this stock is a particularly excellent buy today, but I also don't think it's overvalued. I think it's still a very attractive company that will have good future expected returns. Now we have 4 stocks left, so we're getting through it. We're almost through the entire list. Let's go ahead and start off with the first one here, which is Uber. Uber is going through a transition right now of profitability and scaling, and we can see that represented in the cash flows, particularly the free cash flow. If we look at it on a per share basis, you can see it going from the red up into the green. This is operating leverage and scalability. It's really difficult for analysts to see this ahead of time. So when you're looking at it here, it looks really bleak, but then you see the company get to scale and all of a sudden the fixed expenses stop while the revenue continues to grow. Now the CEO of the company says that this is going to continue on, that everything structurally looks very strong for the company. So even though the free cash flow has grown at 300% per share for the past 2 years, it's likely going to slow down a little bit, but it will still grow very strong over the next 5 years. That is what investors like Bill Ackman are expecting and the CEO of the company. Now, when I look at Uber and we plug in some basic assumptions here, we have a trailing free cash flow of 3.3. If we assume a growth rate of 20% and a yield of 3%, we get 29% returns. 29% per year over the next 5 years, believing that the company will grow its free cash flow per share at 20% per year and the yield is at 3%. None of these assumptions are that extreme. This is something that could happen. This would make Uber worth $273 at the end of 5 years, at Q1 of 2030. So that is substantial growth. To get our 15% return based on these assumptions, we need to pay $136, and we're at 75. Now, let's go ahead and be a little bit more conservative. Let's say that Tesla and Waymo take some market share, growth slows down, it becomes more difficult to compete, they have to spend more on advertisement or something, and growth goes to 10% per year, and they trade at a 4% free cash flow yield. When we have these lower expectations, Uber still gives a 12% return over the next 5 years. The outlier here, and what investors are really pricing in, is that Uber may be totally disrupted, that maybe their network effects get completely disrupted and unravel. So that type of terminal risk is being priced into the stock, and if that really bad case doesn't happen, this stock is undervalued. So in most cases, I'd say 9 times out of 10, like I have repeatedly, Uber is undervalued today. It's a company that I have been debating adding to the portfolio. I have so many great companies already, but this is one that I'd be happy to have in the portfolio. Now, after Uber, we have Intuit. Let's go ahead and take a look at this one. With Intuit, we have a company we could value a couple different ways, through the earnings or cash flows. For this one, I'm going to use the free cash flow. So we look at the free cash flow per share growth of the company. Historically, it's grown over the past 10 years by around 15.7%. Now, if you listen to Intuit's recent earnings call, it was great. They grew again at 20% per year. All the numbers are way above expectations. They're implementing AI. They have a very dominant moat with their businesses, so on and so forth. I think they'll grow above 15% for the next 5 years. But even when I plug in the numbers here, and I use a growth rate of 15%, I use a free cash flow yield of, let's say, 4%. So we factor in a little bit of stock-based comp there that eats into the yield. Even factoring that in, we have a return of around 11% over the next 5 years. To get to the 15% mark, we need to buy this one at $500. So this one gives a positive return today, but it's not at that nice, juicy return of above 15% based on these assumptions. And because of that, I put this one in the fair valued category. If it gets down to $500, I think it's undervalued. Now, next we have Booking Holdings, and come on, you know where I'm going to put this one. You already know, at least if you've watched the channel, you got to know by now. The community knows my feelings on Booking Holdings. Let's take a look at it, and I'll just go over a couple points here. Booking Holdings trades at a free cash flow yield of 5.17%. When you factor in stock-based comp, which there's not much, it's 4.78. So stock-based comp has a 7.5% impact. So very minimal. When we look at the free cash flow per share of this company, it has a knack for growing it continually over decades of time at a very high rate. For example, over the past 10 years, it's grown at 15.97%. They do this through a combination of being an extremely asset-light, highly profitable business with very few expenses, where they can funnel the majority of their money into share buybacks. Share buybacks reduce the shares outstanding, which increases the per share of your free cash flow. And they also just simply generate a lot of free cash flow to begin with. So when you pair that with the buybacks, you get free cash flow per share growth and intrinsic value creation for the investor. We can assume this company is likely going to grow above 15%. It's a very basic assumption. And for what it's worth, I think the travel market may even grow faster. There'll be recessions, maybe that will happen. It could be a temporary dip for a couple years, but overall people love traveling. They love going places. They love having experiences. When GDP per capita grows, so does travel. And travel is inherent. It's a natural part of people's lives, what they want to do. So this company has long, natural secular trends that will stay around for a long period of time. Now I plug in very basic assumptions here. 15% free cash flow per share growth. It'll trade at virtually the same yield, 5%. And based on that, you get a 15.6% compounded return from today's price, making Booking Holdings a $9,600 stock in Q1 of 2030. There'll probably be a share split if they get to that price, because that's going to be hard to pay their employees and it's hard for people to frankly buy the stock at that point. But either way, that's going to be the return, 15.63%. To get the 15% return, that's our desired return, we need to pay over what it trades today, $4,776. Now, let's say that growth slows down a lot, that we get into a recession caused by whatever, and it goes down to 10%. Even then, we're getting a 10% return. Even if the free cash flow yield goes up, meaning people don't want to pay as much for the stock, we still get a 6% return. In all of these scenarios, we have a relatively healthy return, but we have super above market returns, I believe, at very reasonable expectations, making Booking Holding an undervalued company. So this is another one that I add here today. And this is an increase in the list of undervalued companies. That's what happens when companies have great earnings and they're growing and the price comes down. We have more companies in the undervalued territory than I believe we had just a couple months ago. Now, finally, we get to Netflix. This is a stock that's been selling off like crazy over the past couple of days. If we look at the trading of Netflix, it's down another 2.8% today. It's trading roughly in line with other tech companies, similar ones like Spotify. They're both getting sold off like crazy. And when I look at the trading over the past month, Netflix went up to $1,000 per share, and now it's traded down below $900 per share at $880. If I looked at Netflix and the strength of this stock over the past 3 years, it has been one of the most extraordinary outperformers over the past 3 years, 4 years, 5 years. Even if we bought the company right here at the tipping point at the highest price in 2021, it still outperformed the S&P 500 from these prices. So Netflix has been performing incredibly well with a ton of momentum. The stock price has raced up, and I think it's just getting a nice pullback. It likely traded up a little bit higher than it deserved recently. It was trading up with a lot of momentum, even above my expectations. And I think when that happens, in some cases, you have a nice healthy pullback. That's what we're seeing with Netflix. So this does not give me cause for concern. Netflix is a stock that I believe has a tremendous amount of operating leverage, meaning that I believe they have far more control over their expenses and their budget than most companies. They can choose what they want to spend on content, whether that be 17 billion, 18 billion, 16 billion. They determine that spend. It's not dictated to them. And based on that, they can choose to grow their free cash flow per share as much as they want, virtually speaking. So I believe it's going to grow at a healthy pace with organic revenue growth and limited content increases, and that will equate to around 21% per year. If we have a free cash flow yield of 2.6%, which that's an expanded yield over today's price, so I'm assuming that investors are less bullish on the company in 5 years. Even with that, I still get a 12% return based on today's price. So 12% per year is not bad. Now, if they grow a little bit faster, 25%, we get to a 16% return. Or if the yield stayed at the same 2% it was today, we get a 22% return. But looking at a more conservative assumption, 18% growth, a 3% yield, we still get a healthy 7% return. But I believe this one moves into the undervalued category at around 760. So right now I put this one in the fair valued category. And that's it. That's how I view these companies today. Let me know what you think, if you agree or disagree. And as always, if you like this type of content and you'd like to see more of it, you can tell the YouTube algorithm you want to see more of it by liking the video and subscribing to the channel. That's all for now. See you in the next one.